If you're waiting for 2026 to be business as usual, think again. Big tax changes are rolling in next year. Let's talk about the OB3A rules that go live in 2026 and what you need to act on now.
Your creative genius deserves the same precision behind the numbers.
Welcome to Let's Get Fiscal,
hosted by Anastasia, Myiesha, and Danielle.
Part of the women-led team at Coterie Tax.
From smart tax moves to cash flow strategy,
we decode everything it takes to run a thriving creative business
so you can scale with confidence and sleep easy at night.
Press play and let's grow your business.
Okay, so we are recording this a little bit early, but I think by the time you've already listened to this, it's time to do 2026 tax planning. And I mean, we are doing 2026 tax planning in December of 2025. So if you are past December 2025, you are already late. No, one of those things. So really this year, Tax Cuts and Jobs Act was set to expire. So everybody was really, really scared because that would fundamentally change the entire way you file your taxes. You would, again, get, individual deductions and all kinds of different things. AMT would come back, so alternative minimum tax, because there is a tax that when you pay your income taxes, you add in all of your deductions to get to what your tax amount is. But then there's a second calculation that comes through in the back end that sets a minimum level. So if you run your taxes too low, then this AMT will come into play. And we haven't had to deal with that because the AMT limits have been so high. So there has been just so many things that have changed since 2017 in the last 10 years. I mean, some people
How is that almost 10 years ago? First off. But okay.
So luckily we have the O3BAs. So the Big Beautiful Bill Act came in and it extended some of these items for the TCJA or made them permanent-ish. Because anything is only permanent until Congress passes another law. So who knows?
But for right now.
Right, exactly. For today, we'll do that. And this law has made some changes for 2026 that business owners need to be aware of in order to make sure that they are planning effectively through the rest of the year.
Okay. And how does this differ from prior years? Is this really that big of a change that's happening, or this reset? Do you know what I mean? Yeah.
Yeah. In some cases, yeah. It is.
Okay.
It is really big. So, in 2026, bonus depreciation was set to decrease again, but this new bill has extended it over 100%. So now we can continue using the 100% bonus depreciation for different business equipment. So that's great. That happened also in 2025, and we've had that happen in some previous years as well. So not too much. A lot of our smaller creators and businesses would be in a position to use Section 179 anyways. So not too big of a change. But I guess it does kind of play into Airbnb and short-term rentals.
Okay.
So because bonus depreciation is back at 100%, that incentivizes you to have short-term rental and then do the whole kind of cost segregation and, make sure that you're maximizing all of the deductions there. So that still continues to be a pretty viable source of, I can't say passive income because short-term rentals take a lot of work, but it is another stream of revenue that you can bring in once your business is successful. So that's going to continue on and continue to be a strategy. We do have the standard deductions, they've increased, and a lot of the different numbers have increased for inflationary reasons, but we're all used to that kind of being adjusted. So that's not too much of a difference. But one of the things that we have that comes into play in 2026 is charitable donations.
Oh, okay.
So that it is going to be, we call it above the line.
Okay.
deduction. So it is a deduction that you get before your tax is calculated.
Okay.
So it decreases your taxable income, and then your income tax is based on whatever your taxable income number is. So it doesn't decrease your taxes dollar for dollar, but it does help. So in prior years and traditionally, if you wanted to claim charitable donations, then you would have to itemize. And so in order to itemize, you have to have generally more expenses than what you would have under the standard deduction. So they're adding things like interest on your home, property taxes, the state taxes, medical costs, and then also these charitable donations. So in 2026, what they'll do is similar to COVID, where you were able to take that deduction for your charitable donations. You're able to do the same thing in 2026, and it's about $1,000 per taxpayer. So if you're filing married, you get to claim $2,000. So instead of you making a donation, taking the standard deduction, and that donation doesn't go anywhere or do anything, you're actually able to increase your standard deduction by the amount of these donations.
Okay.
So you're able to definitely take advantage of that, and that really helps a lot of the people that have, smaller donations, maybe like a $10 recurring donation to, some of the news outlets and things like that. I see a lot like radio stations and things, or maybe you have, you're donating to the Humane Society or something like that. It's not like a big $25,000 donation, something like that. Normally they're a little bit smaller, so you're able to take advantage of those.
Okay. So bonus depreciation, charitable donations is like kind of changed up the rules there. There's some rule changing with the Airbnb. Are there any other like major changes when it comes to like the impact on creators?
So definitely pass-through entity tax with our S corporations and partnerships.
Okay.
We have to take a look at, because now if your pass-through entity tax payment is more than 102% of your state tax liability, then you don't get the deduction at all.
And now remind us what pass-through entity tax is again, though.
So pass-through entity tax is a way that the business takes on the responsibility of paying the income tax on the profit that it has, which creates, income tax on your personal return. So the business pays the state income taxes on that profit, and then you are given a credit dollar for dollar for that payment that it made. And because the business isn't required to do so, you're able to take a federal income tax deduction for it.
Gotcha.
So, if you do it this special way, make a $5,000 payment in this special way, it can be a federal tax deduction, saving you 20-30%. Or if you paid it through your payroll, you're still paying the $5,000, the same dollar amount, but now you don't get a federal tax deduction.
Gotcha. Okay.
So now, the bill has legitimized pass-through entity tax and, made that a lot, made some rules around it. But like I said, one of the rules is that the amount of tax can't be more than 102% of what you're going to take. So we have to take a look at some of the other activities that you're doing so that we're not, kind of
getting over that.
And, at the end of the day, really, you're not losing the tax payment because you'll still continue to get the credit on the state side. You just won't get the deduction on the federal side. So we have that come into play. And then also we do have the increased SALT cap, so state and local tax deduction. So that was $10,000, which is why the pass-through entity tax kind of came to be. So now it's up to $40,000, which is really great, especially in places where your property taxes are really, really high. So it takes into account your state income taxes and your property taxes most commonly. And then it gives you the ability to itemize on the rest of your return. So
Nice. Okay, cool.
And I think there are some situations where you would still continue to do the pass-through entity tax, even if you are able to take advantage of that increased $40,000 SALT cap. So it doesn't completely get rid of the usefulness of the pass-through entity tax. But again, it's something that it will require us to kind of take a look at.
Yeah, so definitely something to discuss with your tax strategist and everything like that in order to, figure out, make sure it's the right plan for you and you're not going to, do anything weird there. Okay. And then with the changes to depreciation and whatnot, should creators go out there and purchase a bunch of stuff right before the year ends to like be able to use it to the, to the best ability? Yeah.
Yeah. I mean, always, you don't want to wait until the end of the year to purchase all of your equipment because then that kind of changes some of the calculations.
Okay.
If you're waiting until the end of the year to make those purchases. So I always say only invest what you need to in the business because again, the IRS is going to look at intent, do you really need 3 laptop computers, because if they find that something is excessive, they're not necessarily fighting that you didn't spend the money. They're fighting that it wasn't required that you spent that money.
Gotcha.
And
Okay.
it's not something that, like I said, ordinary and necessary. So that's what they would kind of be fighting you on. And if we're just going to chase expenses, there's a bunch of other things that we can do, like pass-through entity tax and retirement and things like that can kind of come into play.
Okay.
But with that said, there's a lot going on. We used to have the tax credit for electric vehicles.
Yes.
So that is all gone.
Oh, okay.
So, I mean, now we have to look at, I guess the big push would be for those vehicles that are over 6,000 pounds. But you have to remember, you have to be able to use it. And it's actually like a necessity for your business. So I always say, I don't need, I don't need a big truck to be able to, carry around my laptop and things like that. But there are definitely businesses where you need to be able to carry around a lot of gear and you need a lot of that space, or you need it to be enclosed in some type of way and it's really heavy and what have you. So I think we'll still continue to see that, vehicles over 6,000 pounds. Just make sure that you do have an actual business purpose for it. And then also when we're talking about electric credits, the solar credit for your personal residence goes away.
Oh, it's gone now. Okay.
Yeah.
Okay.
Yeah. So for the solar credit, it would need to be installed and in use and generating electricity before December 31st, 2025. So it's not just that you paid for it before the end of the year. Was it actually installed and in use before the end of the year?
Okay.
So that's some of the information that you're going to have to provide your accountant, or that they'll be asking, because, just having the invoice showing that you paid isn't necessarily going to be enough in order to take that credit. And that one was a pretty decent credit because that's like a below the line. So you get a dollar for dollar decrease in your taxes. And it was good because it carried over into future years.
Oh, yeah.
So the vehicle tax credit you could only use in that current year. And whatever you didn't use, you lost. Like it was a use it or lose it kind of situation. But the solar tax credit, you could carry forward and use it over 2 or 3 years and decrease your taxes that way. So that is currently gone away. There are some exceptions for some business use property. So maybe if you have a farm or, like a business office building, you'll still be able to take a little bit of advantage of the tax credit. But for general residential homes, it's not going to be available anymore. Okay. So that's also something, that's a pretty big hitter, especially if you were, kind of considering that before the end of the year.
Yeah.
Or you need like a replacement system or something like that. You won't be able to take those credits anymore. So I think we'll probably still see a lot of these like more electric, credits kind of go away. I'm not necessarily sure that will be a forever thing.
Yeah.
So that might be another one of those things that, depending on what the next administration thinks, it may or may not be coming back.
Gotcha. Okay. So I know you kind of hinted at it a little bit at the beginning, but when should everyone start their tax planning for the following year, 2026, which apparently is like 6 weeks away or something like that by the time this goes out? Like,
well, no,
it's 6 weeks away right now. So it'll be 2026 when this comes out. Yeah. Ooh, that's crazy. Hi, future me. But yeah, like when should they like really start that?
Pretty early.
Yeah. Okay.
Because what a lot of people don't realize is April 15th, that is the deadline for your 2025 taxes. But that's also the first quarterly estimated payment for 2026.
Yeah. So you need to know what you need to pay by then. Okay. Yeah.
So in a lot of cases, you need to be able to know what is happening in the year, or at least what's planned in the year, because you're going to be making that first estimated payment. So am I expecting everything to be exactly the same? Am I expecting the business to grow? Will it contract a little bit? Kind of what's going on. And then already just like having those conversations with your tax accountant, especially if you're going to get an extension, then you're kind of getting tax returns. They will give you normally on the front page, there's a nice little letter that tells you how much you owe, and then also the quarterly estimated payments that they recommend. Ours are a little bit different because we deal with a lot of S corporations, so we adjust the amount of withholding that we have people pay on their payroll taxes, because anything paid through withholding is treated as evenly paid throughout the year. So we're able to increase their withholding a little bit to, get rid of the necessity of the quarterly estimated taxes. So, but for a single member LLC or sole proprietor, you can go onto that first page and it'll tell you what estimates you need to pay. And then you can also just kind of pre-schedule them.
Oh, that's nice.
As well. And a lot of the places, as long as you call them before the payment has actually been processed, they can cancel it for you.
Ooh.
So let's say, you pre-schedule April, June, September, and then January of 2027. If something happens in September and you actually can't afford it, you can kind of wait on the line and ask them to, remove that from the system so that it doesn't withdraw from your account. So
that's handy. I mean, it also helps for like, myself and my neurodivergent brain of just like, if I can schedule things in advance so that I don't have to remember later, that's great. Yeah, no, that's nice. So for first quarter 2026, really the thought should be kind of like, what is that estimated payment going to be? I need to start preparing to make that said estimated payment. So just making sure that I'm not like lagging on my financials and stuff and have a real idea of kind of where the business is going.
Right. Yeah. Right. And that's where, in December of 2025, we're already saying, okay, what are the patterns that you're seeing? Do you have any contracts or projects that are already on the schedule for the beginning of next year? Do you have nothing? Like what do you actually see happening throughout the year? And we can kind of make adjustments from there. And then also too, it's really good to kind of pin yourself to a goal of what you want to do. And then that way you can go backwards and you can say, okay, did I actually meet my revenue goal? What kind of changes do I need to make so that I can catch that up? And then also, what do my expenses look like? Am I, spending things in categories that I didn't realize or that I didn't intend to? And do I need to make adjustments to, either my spending habits or my pricing in order to be able to accommodate some of these changes? So those are all things that I think kind of get missed in the very beginning of the year because there's such a huge rush to get all of the taxes done and taken care of. So it can kind of be a surprise. And then by the time you kind of have a little bit of breathing room, now it's already June. So now you have your pass-through entity tax payment and things like that. Also, New York, you have to elect the pass-through entity tax election before March 15th. So there's a lot of things that have to happen in the beginning of the year. So it's really good to kind of just sit down during the holiday season and kind of plan out what the next year will look like. That way you are already kind of pre-planning planning all of your, income, expenditures, everything that's going to be important to you throughout the year. And obviously it's going to adjust.
Yeah.
We do expect there to be quite a few changes. I mean, a baby could be born in a whole year. Who knows? There's definitely lots of changes that can happen, but, making sure that you are looking at it and you are creating a plan as early as before the year even starts. Because there's a lot of things that will take the full year to be able to go through. So like if you know that you want to have an Airbnb home, or short-term rental, to get your down payment, you have to look at the market that you want it in. You have to find a property manager if you're going to use one. You have to identify the property and go through like all of these things, and you have to get it ready. So there's a lot of different processes that will take 6 months to a year. So if you already know all of that information in January, then you can act on that. So just making sure that, like I said, you're layering in all of these changes that are going to happen in 2026 and how that changes some of your planning. Because like I said, I mean, everybody loved the Rivian because you could get a partial tax credit, plus it was over 6,000 pounds and things like that. So, and sometimes when you put the deposit, it can take a while for it to arrive. So if you put a deposit on it, do you still want that vehicle?
Yeah.
Kind of what's going on in some of these, and because these laws are changing some of those decision-making processes, it's really good to just make sure that you're aware of how 2026 is going to be very different from 2025, even though it's not as many changes as we expected. Goodness. So
yeah, okay, cool. Just roll with it. It sounds like it's just a lot of just like taking some time, talk to your accountant, talk to your tax person, and just really like kind of figure it out. And you can have it seems like you just have like very attainable things to make sure you're just hitting those. Yeah, in the next year. Okay.
Yep. So if you have any questions about how 2026 tax law has changed and how to apply it to yourself and your business, feel free to put a comment below or send us an email, and we are more than happy to talk through your particular situation.
Bye, guys.
That's a wrap on Let's Get Fiscal. Ready to stop guessing and start saving? Click the link in the show notes, grab your consult, and let's make your business work for you, not the other way around. You've got this.